Central banks are going to normalize further their monetary policies. Mr. Nieuwenhuijzen, do you think this combined effect could be to some extent disruptive for financial markets?
Well, I think there is a risk that that will happen because of an error in communication by one of the leading central bankers. But I don't think it should be expected as a base case, because overall it will be very gradual. If you look at the total balance sheet of the big 4 central banks in the world, it will hardly shrink over the coming 3 years probably. So I think all in all the impact will be very modest. But there, of course, as we know, the markets look very carefully for each word that is said by Janet Yellen or the new Fed governor or by Mario Draghi. And so sometimes a miscommunication can trigger volatility in the markets.
Rates expectations within financial markets on the one hand and within the Fed itself diverge quite substantially. Who is wrong in your opinion? Do you think markets are to some extent underestimating the path of the tightening?
I think for now markets are right in a sense that it is simply very uncertain how that path of rate hikes will evolve. In recent years the markets have been more right than most of the central bankers or their economists that projected the future path of tightening. And I think the key thing here is that inflation has continued to surprise on the downside, and that the relationship between inflation and other parts of the economy and labor markets has completely changed compared to what it was in the past. And this makes it very hard to forecast where inflation will be. So it will be step by step, and the future path of inflation is so uncertain that I think markets are correct to be very cautious in anticipating future hikes.
Within the fixed income world, government yields are still very low.
Yes.
Where can you find value within the fixed income world?
Well, I agree with you that there is really very little value in government bonds. I think that there will not be very aggressive central banks, but due to the fact that the economy is still doing very well, I expect government bonds to print very modest and maybe negative performances over the next 12 months. So the value is really more found in other parts where you still get a yield pickup. For example, also other regions. So one of the areas that we still find most attractive is emerging market debt. Also there yields have come down and spreads over US government bonds are also tighter, but still they offer attractive value. The spreads are not at record tights yet. And maybe most importantly, and that is very different from most of the last 4 or 5 years, the recovery in emerging market economies is really the most strong and the most broad-based that we have seen over that period. And that really supports emerging market debt, for example.
When you speak of emerging market debt, are you more focused on the local part of it or on the hard currency part of it?
Yeah, it's a very good question. There's a lot of talk about, for example, currencies and whether or not they already reached high levels and you should become more cautious. We do think that local markets are in the short term a little bit more vulnerable maybe than hard currency markets. But in the medium term, I think that currencies still have a long way to move up. And I think it's mainly the bond markets, the local bond markets, that might start to get some pressure on the back of the economic recovery that you see in those countries. So I think you need to be a bit more cautious on the local bond side, but it's certainly not yet an asset class that you need to be defensive about. And I think hard currency debt is still a very steady performer.
Thank you very much.
Thank you.